We're going to give you the two main secrets when it comes to converting to a tax-free retirement that you may want to know before you fall for all the marketing that you're hearing these days about how you too can have a tax-free retirement. Well, there's two dirty little secrets that we're going to cover in today's program that may have you having second thoughts on all of that, combined with the fact that we'll give you, as we do on a regular basis here on this program, an overview of some recent headlines that certainly will impact you and your money. So welcome to the program. This course is Dollars and Cents, one of Central Florida's longest running radio programs, coming to you on a host of radio stations throughout the Central Florida region, along with our podcast channel on any number of platforms, plus our YouTube channel as well. Gives you an opportunity to see whether I am dressed appropriately today or not. For those of you who are keeping score, yes, we got the jacket and the tie on. If you have any trouble finding any of those channels on your particular favorite media network, well, just go ahead and head to our website, Nelson Financial Planning. Upper right-hand corner, a bunch of icons, whether that's Amazon Music, iTunes, Spotify, whatever the case may be, you'll get directly connected to our channel on those platforms. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. Well, as usual, this past week, busy week of headlines for the market. Friday had some employment numbers that were much stronger than originally anticipated. Employers added over 500,000 jobs based upon the most recent data. That sort of surprised people and went directly in opposition, if you will, to sort of the feeling that was generated midweek when the Federal Reserve finally got on board with slowing down how much it was raising rates on Wednesday by only 0.25%. Obviously, that's a big change from the previous rate hike, which was 50 basis points in December. And then, of course, the one before that was actually 75 basis points. So a lot of big headlines coming out this past week. Generally, Wednesday, Thursday, the market sort of liked that news that perhaps the Federal Reserve might be slowing down. And then, lo and behold, you had Friday's economic data, which suggested that the employment market still pretty darn tight. And certainly a tight labor market can have the tendency to produce inflation, because if you've got to compete for people, if you will, from an employment perspective, well, how do you compete for someone to come work for you? You offer them more money. When you offer them more money, that's an increased cost as a business. And what do you do with that cost? You generally pass it on to the consumer. Hence, inflation, or how the labor market can certainly contribute to inflation. But I do think it makes sense for the Federal Reserve to pause here, or at least slow down. We've certainly been talking about that for a few months on the program, because don't forget, these interest rate increases that have been happening over the course of 2022, it takes time. It's not like flipping a light switch on. It takes time for these interest rate increases to make their way. Economists often project that it takes about 6 to 9 months for an interest rate increase to have its full impact in the economic system. So got basically all of the interest rate increases that happened in the back half of last year to still sort of make their way into the economy. So hopefully the Fed doesn't overreact to the employment data that came out on Friday, but continues to say, hey, we're just going to kind of take it easy here and see how all of these things wind up playing out. Stay tuned, of course, on that as we do each and every week. We'll continue to talk about those latest headlines. Also this past week, not sure if you saw it, a great opinion piece in the Wall Street Journal by none other than Charlie Munger. Now, For those of you who don't know who Charlie Munger is, he is Warren Buffett's cohort, his partner. He also happens to be vice chairman of Berkshire Hathaway and Warren Buffett's right-hand man. At 99, still going strong, still has his wits about him, and still one of the most respected voices in the investment community. So, if you're a regular listener to the program, you certainly know our opinion on this crypto stuff, which, frankly, after reading Charlie Munger's opinion piece in the Wall Street Journal, it may make our view not look nearly as negative as his is, or I guess our view of our negative view of crypto may be tame in comparison to his. Here is what he wrote in the Wall Street Journal. The title of the opinion piece: Why America Should Ban Crypto. It isn't currency. It's a gambling contract with nearly 100% edge for the house. The opinion piece in the Wall Street Journal by Charlie Munger continues. Privately owned companies have issued thousands of new cryptocurrencies. These have later become publicly traded without any governmental pre-approval of disclosure. How many times have we heard that before, right? I mean, something happens, it happens very quickly. Government, or at least government regulation, often reactionary, certainly not proactive, and you wind up having consumers hold the bag. Typically what was happening is a block of cryptocurrency would have been sold to a promoter for almost nothing, after which time the public buys in at much higher prices without fully understanding the pre-dilution in favor of the promoter, meaning that he's kept his portion that he wants to keep. That's how he is making his money. As Mark Twain said, a mine is a hole in the ground with a liar on top. Great quote, I guess attributable to Mark Twain. The opinion piece continues. Such wretched excess has gone on because there is a gap in regulation. A cryptocurrency is not a currency, it's not a commodity, and it's not a security. Instead, it's a gambling contract with a nearly 100% edge for the house. His solution, as the title of the article describes, ban it completely. By the way, that's not unlike what already the folks over in China have done, although I'm not sure I want to follow their lead in terms of government regulation and oversight, because, they'll just make up rules and come in and take your business. So be careful going down that path. But certainly an interesting take and perspective from a very well-respected investment guru. So if you haven't had an opportunity to see that article, it is certainly making its way through all the different platforms online, but a very interesting opinion piece by Charlie Munger in the Wall Street Journal. Also on Friday, we posted our most recent blog. So if you're interested in getting a little bit more information about some of the topics that we've talked about on the radio program, we do that in the form of a blog post on our website, nelsonfinancialplanning.com. The post that we did on Friday actually talks about some of the 2023 tax changes. So when we return, we're going to talk a little bit more about that blog post and then have a follow-up conversation about interest rates and specifically what the banks are paying for those savings rates that folks have. All that and more coming up next on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking a little bit on the program today about the blog post that we put up on our website at Nelson Financial Planning. That blog post, something that we do just about every month, we kind of take the time to put together a little bit more written description of perhaps one of the topics that we covered on one of these programs. Well, the blog post from this past Friday talks about a very timely topic, your 2023 tax changes. And certainly we were fortunate enough to be joined for a couple of programs in January with our fellow certified financial fiduciary, also fellow certified financial planner, who also happens to be a CPA, Kristen Cayley, a member of our team at Nelson Financial Planning, talking about some of the highlights of the tax changes for the year 2023. We've detailed those in much greater length on the blog post, because you can do that when you're typing away versus the limited time that we have on air with you folks. So the reality is, just to hit the highlights, a lot more information on the blog post. Obviously, we've talked about the 1099-K, the tax document that shows your gross sales on platforms like Etsy or eBay or what have you. That rule pushed to next year in terms of requirement to generate out those tax documents. But certainly if you have a business that you do online like that, those are the kinds of things that you need to really start thinking about now, though, because you want to certainly be organized, because that rule, while it might have gotten delayed, it did not disappear. Be careful about how much you're putting in on your taxes during the course of this year. You want to make sure that you're covering your tax bill, because the underpayment penalty jumped to 7%. So certainly some big numbers, if you will, on that, and some big costs. So make sure that you're checking your tax withholding, particularly here in the new year. Similarly, for last year, that charity deduction, the $300 for single people, $600 for married couple, all went away, so you don't get to do that. The EV tax credits, which everybody thinks they're going to get, be aware that there is a lot of rules or restrictions or fine print, if you will, in terms of being able to claim that credit. Anyway, all of that in much greater detail. So we encourage you to go to our website, nelsonfinancialplanning.com, and you'll see the blog post that kind of gets into a lot more details about some of those big tax changes. Also in the blog post, we spent a little bit of time talking about a topic that we talked a little bit about on a prior program, and that is some of the discussions, if you will, about the shortfalls of using online retirement calculators. Certainly a tremendous amount of folks use them, and not to say that we throw all of the tools out, but just understand that any software or any online program is always going to make some assumptions. And the reality is that based upon the assumptions that a typical online retirement income calculator does, the results only apply to like 4% of the population. The reality is that there's much more unique factors that come into play for each and every person as they get to retirement and when they're thinking about planning for retirement income. So the reality is that it's important that you wind up having a retirement income plan that is unique to you. Some of the things that we point out in the blog post is that everybody's health is different, everybody's lifespan is different, everybody's expectations versus reality, the timing of Social Security, their risk tolerance, their spending patterns, how much they want to leave to the next generation, all of that comes into play. So make sure you check that out on our blog post at Nelson Financial Planning. A lot of details, if you will, in terms of some of the things that folks need to be aware of when thinking about retirement income. And the reality is, using one of those online calculators, yeah, okay, maybe that's a good start, but the assumptions that are getting made typically only apply to about 4%. So probably chances are you're in the other 96 and might need something a little bit more custom, involving a conversation about exactly what that retirement income plan looks like for you. So if you're interested in that, that's certainly something that we talk about with our clients and friends every day at Nelson Financial Planning. So if you'd like us to review your retirement income plan, don't hesitate to go to our website, Nelson Financial Planning. You'll find a little contact us box there. Fill it out, send it our way. Someone will give you a call tomorrow during business hours, or you can pick up the phone, dial 407-629-6477, and you can reach us that way as well. Guess what? There'll be a live person that answers that phone as well, because we still believe in that approach. Now, speaking of approaches, one of the things that we talked about on a prior program was the notion of how much consumers are missing out when you look at the amount of cash that is still sitting at large financial institutions. And at the end of the day, the large financial institutions really have not changed how much they are ultimately paying on the interest that people make on savings accounts or bank money markets or any of those kinds of things. It's certainly upticked a little bit since over the course of the past few months, but the reality is that those rates are still well below where they would be when you look at what those savings rates should be based upon what the overnight lending rate is. And so there was an estimate that came out, and a statistic that we shared with you, that in the third quarter of last year, Americans missed out on like an extra $42 billion of dollars that they should have gotten simply because their money was sitting in low interest rates accounts that were not making anywhere near what the prevailing rates were. Well, lo and behold, along comes the Bank of America earnings call, which happened in mid-January. And you gotta love the candidness of some of these bankers. And certainly Bank of America CEO Brian Moynihan would be on that list. In the conference call, he noted that $560 billion in consumer deposits at the bank, at Bank of America, this is one bank, were in consumer deposits that were in low or no interest-bearing checking accounts that collectively paid an average yield of 0.06% or, at the time, 3.66% below the average Fed funds target rate during the quarter. Another way of saying that is that the banks aren't raising your interest rates fast enough to reflect what's going on in the market, and individuals are certainly missing out on that. Now, the good news, because we got a little bit of good news on that, is that people have started getting smarter to that. Hopefully that's because they're listening to programs like this. The reality is, if you look at the past 4 weeks, money market funds had inflows of $135 billion. Why? Because typically your typical money market mutual fund these days is having a return of about a yield of around 4%, something we haven't seen in many years on these money market funds. When I started in the late 90s, those funds were paying 5%. Fast forward 2 years, 9/11, where they cut rates and kept them low, you wound up having like 15 years of 0%. Past 6 months, those numbers have jumped dramatically, and certainly that inflow to money market funds over the course of the past 4 weeks was a very high level. Remember, of course, the difference: money market mutual funds, not FDIC insured, but generally follow in lockstep to the overnight lending rate. So predominantly because those funds will hold things like T-bills, which are short-term treasury issued securities, usually 90-odd days, and commercial paper, which also has a 90-day limitation. So average yield slightly above 4%, record high of over $5 trillion in money market. Ready cash still says that the consumer has money to spend. The reality is that it is certainly a great opportunity to earn a little bit more, particularly on that cash money. Now, be careful. Don't be sitting on an excessive amount of cash, because ultimately there's no opportunity to really stay ahead of inflation and taxes with that approach. But for your emergency savings, there are clearly better options to make a little bit more money along the way while that money stays in that more secure venue. So with that, we'll take a break and return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. A couple of new provisions relating to your retirement were included in the Secure Act 2.0, and we're going to share those with you, but we're going to share those along with a conversation about some of the main secrets that you don't hear when folks talk about a tax-free retirement. All too often you hear the ads, don't you want a tax-free retirement? Well, of course, everybody would want a tax-free retirement. But there's a couple of secrets that are lurking in the background that may give you pause before you jump into all of that marketing hype. So we're going to talk about those here on this segment of the program here on Dollars and Cents. I'm Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where we got a whole team of certified financial fiduciaries that stand ready to help you change your life with a successful and cost-effective financial plan. So what better time than the start of a year to say, hey, you know what? Maybe a second opinion, a second look at what I'm currently doing might make some sense. Well, guess what? We're happy to do that for you, and we do that at no charge because all of our consultations and conversations with folks are done without any charge. You can always come in for a conversation at any point in time. So the Secure Act 2.0, gotta love the wording, if you will, that the folks in Washington come up with on these bills, right? So SECURE stands for Setting Every Community Up for Retirement Enhancement. That's a mouthful, but that is the marketing that happens up in Washington. So here's two changes for 2023. And this is an important development, and we wanted to kind of share with you. And what we've seen is that on the traditional employer side of things, typically the way in which you can save for retirement is often, or almost exclusively, on the pre-tax side of things. So the pre-tax side of things is the way that is the option pretty much you've always kind of had. But starting this year, 2023, employers now have the option to allow employees to decide whether to take employer matching and non-elective contributions on a Roth or after-tax basis. The employer may deduct the Roth contributions, but the employees that take the Roth contributions obviously would take them as income, and then the contributions and earnings thereafter would be subject to normal Roth rules as well. For tax years also beginning after 2022, so that'd be 2023 and going forward, that same feature is available on Simples, and it's also available on SEP IRA. So employers now able to offer the Roth piece on their contributions on the Simple plans and also on the SEP plans as well. So what the Secure Act did is it obviously expanded a tremendous amount of opportunities for folks to be doing Roth contributions as it relates to their retirement. And what is interesting about that is, well, I guess you have to think about the logic as to why the folks in Washington would do that. The reality is that, remember, when you do a Roth, that's after tax money. So that means that the folks in Washington are getting the tax revenue on that money now rather than later. One of the things that's so frustrating to folks in Washington is you got all this money in IRAs, retirement accounts. It hasn't been taxed. We need to tax that money. That money's been sitting there growing tax deferred, and we got to figure out a way to tax that money. So let's just make sure that we try to encourage everybody to do the Roth instead. Now, you may think, well, Joel, I didn't realize you were that big of a conspiracy theorist. No, I'm just understand the numbers and how it works. Money coming in, that's what Washington wants right now. Money later, those guys don't think about the future all that much. So just be aware of what the logic is behind the Roth up in Washington, and that may make you think a couple of different things on the Roth versus the traditional. There's also a couple of secrets when we talk about that, because when we think of the Roth, it's certainly a very valuable option. I don't want to, paint it in a dark corner here. Roth is a great option for folks that are younger, right? The reality is that if you're in your 50s, like myself, there wasn't really a Roth option, right? I mean, they just introduced it this year, 2023, for employer contributions for SEPs and Simples. So it's not a concept that was generally available to us in our early years of working. But if you are in your early years of working, there's certainly some appeal to sort of think about using that. But the problem is, though, as you get older and as you get further along, if you're in your 50s, chances are you should be sort of in your peak earning years, right? I mean, isn't that kind of how it goes? Hopefully you're not making the same today if you're in your 50s than you did when you were just starting out in the workforce when you were in your 20s. So that's part of the secrets that folks don't talk about when they talk about, hey, let's have a tax-free retirement, because there's two main dirty little secrets that folks don't really appreciate. And the first of which is, in order to get a tax-free retirement and you got all this pre-tax money, what do you got to do? Well, you got to do a conversion. And when you do that, that means that you are paying taxes now at whatever your highest marginal tax rate is. Okay, well, back to the fact that if I'm still working and in my 50s, chances are should be pretty close to my peak earning years. So that means that you're going to be paying taxes at a relatively high rate. Now, of course, you should run the numbers and run the analysis on it. If you're below and in the 12% bracket, or maybe you're in the 22% bracket, there may be an opportunity to take a portion and fill up those brackets. But again, if you're a married couple making decent money, you do a conversion, it's going to cost you 24, maybe 32%. That seems to me pretty pricey, in our opinion. Number two, and this is the other part of the dirty little secret, well, if you did the conversion, you got to pay taxes, right? And the IRS, they don't take credit, or when they do, they charge you 7%. And so consequently, this is the one that you've got to be sort of careful with, because the money then has to come from somewhere, right? Okay, I converted. Okay, now I got to pay the taxes. Where is that money coming from, number one? And what's the opportunity cost on that money? What if I took that money and invested? What if I took that money and did something with it that further increased my overall investment picture? And oh, by the way, that money is going to be after-tax money, because after-tax money is what you have to use to pay the taxes. So if I'm doing that, then if I invested that money would be invested outside of a retirement sort of envelope in the first place and subject to lower taxes anyway. So consider the tax bill, if you will, and where on earth that money is ultimately going to come from. And those are really the two big dirty secrets, right? Tax-free retirement sounds great, except I got to do a conversion. And when I do a conversion, I got to pay the taxes. And when I pay the taxes, that involves money. That involves sending money out of your pocket to the IRS. If you're in your 50s and 60s, chances are you're in your peak earning years. So be very careful on the analysis that simply says, don't you want a tax-free retirement? In addition, if you're on the lower end, the thing you have to watch out for is that if you're retired collecting Social Security and someone says, you're in a low tax bracket, you should totally do this. Be careful, because you may find that you're more and more of your Social Security, because see, when you convert, that's income and that's retirement income. And ultimately then that could trigger more and more of your Social Security to then be taxable, thereby doubling up the amount of tax that you pay for the conversion. If you're in your 20s and 30s, okay, fine. There's a stronger argument for you to do the Roth over the traditional, because income taxes are lower now, particularly between now and 2026, and you're younger and making less money. We're going to take a break. When we come back, we're going to finish up this conversation about the dirty secrets about converting to a Roth, and then continue on with the conversation here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So just to recap the conversation in the prior segment, talking about two of the dirty little secrets when it comes to this notion of a tax-free retirement. You hear all the ads, you hear all the promos. Don't you want a tax-free retirement? Well, yeah, I'd love to have a tax-free retirement. The problem is that there's a couple of dirty secrets that come with that. Number one is that means I'm converting IRA over to Roth. Well, what happens when I do that? Then the amount that I've converted then becomes income. If I'm in my 50s and 60s, chances are I'm in my peak earning years. So guess what? That's going to hit at the highest marginal tax bracket that you're at, versus a lot of the money that was saved maybe when you were in your 30s and 40s and not in that peak earning years. So be careful of that, number one. Number two, when you do a conversion, it takes money to pay for that. That generates an immediate tax bill. The IRS doesn't take IOUs. Well, they do, but they charge a lot for it. So if you're going to do that, know that you've got to get that money from somewhere. What's the opportunity cost you give up on that money by sending it to the IRS? Because you send it to the IRS, that's it. They keep it. There's no way to get it back. What could that money do otherwise? Because it's after-tax money, right? You pay your taxes on an after-tax basis, not on a pre-tax basis, especially when you're doing a conversion. What could that money do? It's after-tax money. If I invested it, if I saved it, I'd have a whole nother pot of money that's available for me to use in retirement. Now, understand this. As with anything, it's important to always run an analysis. Run the numbers, as we've been saying for 30-odd years on this program, before you make any kind of a decision about this. It's important to understand, though, that if you're filling up the higher tax brackets, all of that conversion amount is going to be at your highest marginal tax bracket because it's extra income. It's income above and beyond what you would have gotten for that year because you elected to do a conversion. So what that means then is that you're having extra income, you're paying extra tax. What's the opportunity cost of those dollars? The younger you are, the more that potential contributing to Roth along the way makes sense. But understand that those options are brand new. As we were saying in the last segment, this is the first year, 2023, where you get to elect that your employer contribution be done on a Roth basis. That's never been allowed before. The only option was always on a pre-tax basis. Similarly, if you have a SEP or a simple, the employer contribution now allowed to be done on a Roth basis. 2023, first year for that because of the changes that were made in the Secure Act that passed in the last week of December. So what that means is that you've got a very different set of circumstances and opportunity, particularly if you're in those accumulating years. But if you're starting to approach those years where you're going to start to spend money, I would submit that maybe you don't spend a bunch of money paying Uncle Sam. Maybe you just look at what's the best way to more tax efficiently plan my retirement income, right? That goes back to the conversation we were having early in the program about how the retirement income calculators don't really hold water for the vast majority of people because everybody's situation is different. That's why it's so important to make sure that you're having a personal analysis done on what your income is going to look like in retirement, including what the tax implications are of that income. So make sure that you're paying attention and don't believe all of the advertisements that are out there. As we all know, if someone's talking about a tax-free retirement, there isn't anything free in this world. You're going to pay, you do the conversion, you pay taxes now. Money's got to come from somewhere. There's always an opportunity cost on money, particularly when you send it straight out of your bank account and off to the IRS, never to be seen again. And then don't forget the other reason of why these retirement contributions were set up as pre-tax. So let's think back to the history of where all this started. The notion of pre-tax retirement savings was intentionally done to encourage people to save more. Why? Because effectively with the tax deduction, you can put away a little bit more than what you might otherwise be able to do. And if you look at the history of all this IRA versus Roth stuff, that's the history. That's where the concept came from in terms of making those retirement contributions on a pre-tax basis in the first place, was to encourage people to put more money away. Why? Because if you put more money away, when you're younger, the power of time and compounding works wonders. If you're putting less money away because you're doing it on an after-tax basis, you might not have as much at the end of the day. You certainly wouldn't, right? The notion of why those retirement contributions were set up on a pre-tax basis was to encourage people to save more. Now, the message has all gotten convoluted because, it's all about tax-free. Well, understand Washington's perspective on that. The reason why the folks in Washington encourage Roth is because it generates money now when it is needed in Washington. Hey, I don't know about you, but if you want to help support what they're doing up in Washington, be my guest. Me, on the other hand, I'm going to make sure that my taxes fully paid what I owe, but make sure that I am operating life in as tax-efficient manner as possible. So look at the history of where these two types of things came from, the traditional contributions, the traditional retirement contributions, and the Roth. You'll find some interesting things in the legislative history and in the legislative record of when these things were first introduced. So don't forget about that on the pre-tax side of things, specifically intended to try and encourage people to save more, not less. Anyway, speaking of advertising, well, first of all, let me identify the program. It's Dollars and Cents, if you haven't figured it out. This is where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest-running radio programs, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite podcast platform, or if you want to see what we look like in real life, you can go to our YouTube channel as well. Simply search for Nelson Financial Planning or Dollars and Cents with Joel Garris. You'll find us. Any trouble finding us, go to our website, Nelson Financial Planning, upper right-hand corner. You'll see the icons. Click on the one that looks most familiar to you, and voila, you'll get immediately connected to our program or our channel on the particular platform that you're looking for. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a whole team of certified financial fiduciaries that stand ready this week to help you change your life with a successful and cost-effective financial plan. Speaking of advertisements, this one is percolating a tremendous amount, and we wanted to just take the last few minutes of the program to talk a little bit about it, because we have been, if you have a business or if you're self-employed, you probably have seen the increase in emails, the increase in letters. I'm looking at one right now that actually came to the office. And the letters, the emails, well, they never look really legit. You shouldn't really answer any emails these days. But the letters look sort of legit and almost looks like it's a letter from the IRS. It's got a 202 phone number, so that means it's a DC number. But it talks about the employee retention credit and how we can go in and for a 20% override, we're going to go and get all this COVID money that you could get and you didn't get. Folks, be very, very careful of that. We're going to talk more about that one on next week's program, because the music means we're out of time. So that's about it for this week's episode of Dollars and Cents. If you like what you heard and want to learn more, check out our website, Nelson Financial Planning, or call the office 407-629-6477. Hope you enjoy the rest of your Sunday here in Central Florida.